Absolutely. And based on some of Leslie's reporting, there's just weak demand for WeWork. But you've also seen it with Uber and Lyft. So these high growth, huge companies that have stayed private for a decade have been a reality check for Silicon Valley, that business model isn't working necessarily. And so investors I talked to this week were saying, you know what, it's shifting the conversation in boardrooms. They're now saying we need to focus on economic metrics, cash flow, instead of just users.
What a thought.
Yeah.
Users and revenue, right?
Yeah,
it's revenue. Right. They're seeking
and they're
revenue.
Saying, yeah, we're going to go. And you're kind of seeing this sector shift like you might see in public markets. If you're switching to defensives amidst a trade war, same thing for private equity. They're now saying, all right, it might be time to look for those safer names instead of these high growth, SoftBank-backed companies, whether it's Uber or WeWork.
It really is a perfect case study of behavioral finance where you look at herding mentality of these investors in Silicon Valley, where a couple of years ago, if something was basically a decacon, if it was valued at $10 billion or more, then you know what? It couldn't do any wrong. It was a safe bet in a sense that you could just keep putting your money behind. If SoftBank was in there, if these smart investors were in there, then, everything would be okay. Now we're starting to see somewhat of a reckoning of that mentality, this idea that, maybe it would have been better if you had kind of looked under the hood a little bit rather than just kind of piled into these fancy marquee investments.
Right, or brought that public market discipline into, your office sooner. I mean, that I think becomes the real question, which is this going to change the time horizon, the length at which people say, I should remain a private company? And by the way, what happens if WeWork at the end of this says, now we're better off being a private company?
That's what people are saying in boardrooms, that sense of discipline is needed. They're saying it's either you go public sooner or you focus on different metrics. But it's a wake-up call. I think people were waiting for WeWork because you had Uber and Lyft, and those are ride-sharing companies. But this seems to, the common thread here is that they are all losing money. Renaissance Capital did some great data about over the past 2 decades, the biggest money losers, all of them are underwater except for one company, the top 10. So it seems to be the issue here is really that they're not making money ahead of that, and it's dangerous for IPO investors.
Well, you look at that chart, which is really instructive, and you see the 3 maybe most highly anticipated IPOs of the past couple of years. Remember how people were just banging the drum on it? When are they going to go public? When are they going to go public? Well, it hasn't really. It's gone public with a thud, right?
Yeah, although I bet they're pretty happy they went public before WeWork did, because they were able to get out the door. Not a decent valuation, not too dissimilar from where they were valued privately, but if you recall, Uber also went through a lot of their corporate governance changes while they were still private, before their prospectus had been filed, with the whole management shift with Travis Kalanick leaving the company and bringing on a new CEO, Dara, to kind of clean things up. And they had 1 vote per share. So a lot of those corporate governance things took place behind the scenes.
That I think is so important and interesting right now. The Business Roundtable just did a splashy thing about, shareholder first capitalism is not the way to go. We need to expand the stakeholders. Well, look what the shareholder first public markets are doing to improve these companies. They're requiring them to have better, to be run better, to have better corporate governance, to figure out how to actually have profitable business models, to take into account what they need to do internally to, maybe not hand perks out the door. I mean, those are all the kind of discipline that makes them better in the long run. And maybe some people in Silicon Valley disagree.
Yeah, I think that's a really good point. And it is the opposite side of the Business Roundtable's point that companies should, in essence, prioritize all stakeholders involved in their company, employees, suppliers, customers, things like that, which the shareholders would argue, if we're owners of this company, of course we want them to be good to their employees.
Absolutely.
Of course we want them to be good to their suppliers and so forth. The dual class share structure thing, or in WeWork's case, triple class share structure, is still an interesting dynamic that we do tend to see more and more with Silicon Valley that does push back against the shareholder rights dynamic.
Look, you can understand it. If you're a founder, you should have some ability to retain control and not get totally pushed around. But I mean, look, the media companies have had it for quite some time.
Exactly. Definitely a silver lining of this. And people have said they were waiting for WeWork to see if the IPO market was still the public arbiter, and said, okay, there's not demand and there is an end to it. You don't see that high growth. The $47 billion valuation was unrealistic. And people had thought that. Venture capital investors who weren't in WeWork said they've been saying this for years. And now they're saying, okay, at least it's realistic when it goes to IPO.
Right. We've been vindicated.